So, Matt, if these commercial real estate prices, if they are in flux,
Yeah.
what does that mean for potential distress in the market? Because we've spent a lot of time talking about potential distress in the market also. So,
Yeah.
I mean, is the gig up and no more distress? Can this distress get in the way of your prediction of higher prices near the end of this year?
That's a really good point. I feel like it's probably not gonna have a that kind of crash dramatic effect, but it will lead to opportunities, and it will be an ingredient in the market. That I think that when we're talking about distress, it is something that you were alluding to earlier, the kind of lower, maybe Class C properties that are already struggling, that they planned to do a value add, maybe they couldn't afford it, or they didn't get the rent growth out of the value add, but they still have the costs associated with it. So there, and it's not like these aren't happening, and there are a lot of them that are happening in markets that were growing in terms of population, maybe job growth, but the supply is still way out of whack. So we always bring up, let's say it's somewhere in Austin or Phoenix that it's like a Class C value add, and rent growth there is negative, and that could get you right up on this chart here.
Yeah.
And so what CRED IQ is finding is that their measure of distress has increased after about 2 months, where maybe it was three. What does it say here?
Yeah,
three consecutive reductions, and then it jumped back up.
For delinquency.
Yeah, for these delinquencies, or this kind of
distress rate, delinquent, specially serviced, and delinquent and or special service.
They're a little bit. We may get comments in YouTube about the technical definition of distress. I'm just going with the general description that is used in CRED IQ.
Yeah, give us. There's a couple different definitions out there. Give us a little bit of leeway.
Yeah, exactly. I think, and so but my bigger point is, we talked about this about a month and a half ago. I said, there's a little bit of a
surprising.
Things were easing up in terms of delinquencies and distress, and we were saying, yes, this could be the case, but we also said, I remember saying, like, I'm not ready to call this a trend yet. Maybe it's a momentary blip, and here's our blip. So it's blipping back up.
Can I throw something out there?
Yeah.
Just think about another report that we looked at a couple weeks ago, maybe a month ago.
Mm-hmm.
Big surge in refinances, or restructuring of loans kind of earlier in the year. Like a lot of volume, but like not a lot of like new transactions, but there were a decent amount of like refinances.
Okay. Yeah.
So if someone refinances, they do a cash in, they kind of reset, their overall debt load, the interest rate, they kind of right size the loan, assuming they would do that in an outcome that would put them in a non-distress situation. So I guess the question is, is this reflecting actual improvement in property performance, or is this taking some of those delinquent or distressed properties and loans off the books, shifting them into kind of performing because the debt has been right-sized, because essentially an injection of capital and a restructuring of the capital stack?
No, that makes sense. And
I'm not saying that is absolutely the case. I'm just saying that those two things have this, they kind of overlaps.
Yeah. It makes me think that there may be like a upper threshold where that'll reach before, then some people will have to be forced to do that, and it won't.
And I mean, there has been some. I mean, we'll talk about fundamentals here in a second. But I mean, this also overlays with prime leasing season, which has been subdued relative to expectations in previous years, but there has been some, positive momentum, some positive, month over month rent growth, even, depending on who you ask, maybe even some positive year over year rent growth. Obviously in different markets, can tell a very different story. But let's say that, again, there's just been a little bit of growth. And so, that could have been the difference, putting someone's, income statement in a position of where they can actually cover that debt service with a little bit of cash afterwards. Those are the two factors. I put a little bit less weight on that one though, because I don't think there's been enough movement.
The fundamentals are largely unchanged, and what we can talk about them in a little bit.
A couple dollars more, an average rent per month. Isn't going to save your property.
Agreed.
Over 3 months of leasing.
Totally.
Talking, dozens of leases. Property.
That's what that is really surprising, and I think that those decisions will be probably made between the banks and them. That's the meaningful decision. It's not the meaningful. The meaningful data is not a couple dollars of debt growth, of rent growth. It is the culmination of years of stagnant stagnant growth and low NOI or negative. I want to talk about the breakdown of these as well. So distressed loan payment status, the biggest chunk of these are non-performing matured loans. 38.6 of these distressed loans that they're tracking are,
and this is all CMBS,
category.
I believe. Correct?
I'm not sure what they capture. I think that they capture.
Sure.
Okay.
Let's assume it is until we see otherwise. In which I think it's a decent proxy. I mean, obviously the majority of loans in multifamily are Fannie and Freddie, and then there's CLO, which is more of like your bridge loans and bank loans, and then there's like debt funds, and then there's the CM conduit, the CMBS market. Yeah. Obviously different terms, but they overlap in, I guess, origination periods. So even if we're just looking at CMBS, it gives us a little bit of a bellwether. Yeah.
That's a big chunk. It represents billions of dollars of matured loans that are not performing.
I mean, only less than 18% are current. Yeah. I mean, I think that is, we can break it down between how delinquent or, in a grace period, performing but are, matured, but I guess that's fine. So I could say 40% of the market, because we can throw in the performing matured, although again, they've gone past the maturity data. I'm just wondering, what's up? Maybe they're performing, but that doesn't mean that the value's there. The values could still be underwater. Mm-hmm. So, 20% is just current, 40% is current, but half of that, they've blown past their maturity date. Then 80% is either past the maturity date or non-performing. Yeah. And, almost 55, close to 60%, doing some quick math, is non-performing past its maturity date or in some stage of delinquency or non-performant or grace period.
I wonder if this is going to have an effect on the market in terms of transactions. I also wonder if this is going to have, and it's something I maybe never have talked about, only just like sidelong ways in terms of, no, it's just interesting. I just think it's kind of interesting. Well, it's a little bit riskier. Talking about other companies, other syndicators, other investment companies that it's not just like these assets are perform or the markets could perform. This could mean the success or failure of other companies like CRED Capital. Yeah. CRED Capital is not in this situation, but it does make me nervous for other similar companies that may be facing this, and suddenly their investors are calling them about capital calls, and suddenly they maybe aren't a company anymore. So what if it thins the herd instead of maybe leading to a meaningful decrease in multifamily property prices? What if it leads to a meaningful decrease in the amount of people that are in the industry?
I think that's already happening right now, and no one's going to make a big LinkedIn post and to say like, hey, you know what, I'm slowing down my business. I'm moving on to something else. Yeah. But that 100% is going on right now. I mean, from folks that were just getting started and like there's no deals to do. It's hard to raise the capital. Mm-hmm. It's hard to find the deals, win the deals, especially if you don't have a track record. It's hard to do just any kind of volume of deals, just support like a business. Like there's certainly like scale that is required to continue to operate in this business meaningfully if you want to be a true operator. Just having one deal doesn't pay the bills. It doesn't kind of pay you enough to eat unless you're just charging so many crazy fees. But then it's hard. You're not going to be able to raise the deal's not going to pencil. Not going to be able to raise the money doing that. Yeah. For like great capital, which we're large enough where we can sustain, and we did a lot. We did a lot of deals prior to COVID. We did a lot of deals prior to COVID before we brought property management in house and all of that. So we were going through exits throughout 2019, a little less, not really a lot in 2020, but 2019, 2021, 2022, 2023, we had exits in all of those years that were all profitable and successful that allowed us to kind of capitalize in a way to sustain a period of lower transaction volumes because most real estate businesses, not all, do rely on transactions to a degree to kind of cover ongoing operating expenses. Yeah. We have recurring revenue from our property management fees, asset management fees, but in that pays for a big chunk of our operations, but it doesn't cover the whole boat. So we're in a position of where it's like, we don't need a deal, but like, a deal would be good. Alex and I, we've invested more cash into the company and, we're going to continue to do that. Mm-hmm. But if we were in a position where we had to do that, plus we had deals that were suffering.
Yeah.
I mean, we're incredibly fortunate through decisions we made, some luck, through a lot of different factors. We don't have any deals that are distressed or we can't pay the mortgage. All of our deals are distributing. All of our deals are in the mid 90% range. Up to like 99% occupied. We've got one deal in the mid 80s, but we've got plenty of debt service. We've got a healthy DSCR. We bought it right. We're still in the middle of we bought it. We've owned it for about a year.
Yeah.
So we're still seasoning. Going through the plan. But the portfolio's in pretty good shape. Allows us to sleep really well at night. If I had deals that were underwater, we couldn't pay the debt service, we were issuing capital calls to investors, or we were thinking about issuing capital calls to investors, or if we had loan maturities that are coming up. We had one deal.
I think about it a lot. How do they do it? How do they do it?
I mean, how do they sleep at night?
How do they sleep at night? How do they go to work and not sweat through their clothes thinking about what the next day is gonna hold? Yeah, how do they look people in the eye?
There's a lot of you have to have some you have to be resilient and
Yep.
optimistic and be creative and figure stuff out. And there's some stories so people figuring out. The Nitya Capital. They just secured like a $700 million big refinance for a portfolio of properties in the Sun Belt. Properties, again, I don't know, no knowledge about the deal or the properties, or no much about Nitya Capital, but other than they're a pretty decent sized operator and bought a lot over the last couple of years, and one of those groups that you could put in you could see them being in a tough spot because they bought a lot with probably floating rate debt in the Sun Belt.
Yeah.
They were able to restructure those loans. I don't know how much cash they had to put in, but they at least got them to a point where we were able to negotiate it to where it's like, or we can at least live to fight another day.
Yeah.
And they'll probably get to the other side, maybe. Again, without any inside knowledge of the deals. There's other groups like the Tides Equities guys that, they're getting full recourse guarantees being called.
Yeah.
Different story. I'm sure they've got some of it worked out. Some of it they haven't been able to work out. But for the right operator, there are deals to be made. And again, you've brought it up, all of a sudden, it's a lot different if you own, the bank, $100 versus $100 million. Yeah. And if you own $700 million, there's a little bit of incentive for the bank to work with you and make a deal. So, again, certain operators can navigate it. Others will not be able to. And back to your earlier point, should thin the market a little bit. And that's what happens in markets. It got a little bit easier than it should have been during a period of time, starting, call it before 2020, 2017 or so, because interest rates were low, there were rent growth, and there was steady cap rate compression. And our business model was super straightforward. Our tactics were different then because it wouldn't work. We did a lot of, and again, all of this is Cosmo bridge loans, but we used to do a ton of bridge loans.
Yeah.
We would do bridge to HUD. So we'd take out a bridge loan, including a line of credit for a rehab. So we'd be doing a value add deal. We would get a loan for the rehab. We would execute the rehab within 9 to 12 months, start moving rents. Oftentimes we were getting rent bumps without doing even much of the rehab.
Yeah.
And then we would take the bridge loan out with a basically pre-planned HUD 223F loan, fixed rate financing. We would lock the rate for 35 years.
Yeah.
And that was kind of the business plan. You do a value add, you do the work, you get rents, you fix the debt.
Things make sense
and you
back
cash
then.
flow it. And we were cash flowing 9, 10, 11% year one.
Yeah.
And then when you put the full amortizing 223F loan on it, you're still cash flowing 8%. It was great. And you're amortizing the debt. And you needed to know, you had to put all the pieces together.
Yeah.
You had to be knowledgeable of it, and you certainly had to know enough. But it was relatively straightforward, at least in my perception of going back thinking about it. Today it's much more nuanced, and the execution is different. It's not clear.
Yeah. Look at these, we got two takes on the CRE market. We got two takes on the multifamily market. There's a lot that's unclear. I still want to go back to something that I was saying earlier is like investors, I think a lot of them are thinking about 2026. Yeah, there's maybe a lag between current vibes and like later actual prices, but I don't think that investors are thinking about the later prices. I think they're thinking even past that.
Yeah.
And that's maybe just the nature of those
I'm getting those vibes as well. I was at an investment conference last week and just talked to a lot of folks, and I am hearing people say that. I think that the kind of the word is out that like, hey, we've stopped building.
Yeah.
Again, I'm getting these are anecdotes, but the number of developers that have reached out to CRED Capital in the last 2 weeks.
Interesting.
And then if I think back the last 6 months, it's staggering.
Yeah.
Multiples over previous years who are coming to CRED Capital for development equity, like JV development equity.
Okay.
It's not something we really do. It's not something that we are opposed to. It's not been our bread and butter. It's not been our strategy. I think that if you can find a development deal that really pencils and actually pencils, it would be interesting right now because you'd be delivering when no one else is delivering.
Yeah.
And so, and I was scratching my head because I'm like, I heard that no one's developing, but all these developers are coming to us saying like, we're going to build here, we're going to build here, we're going to build there. And they're like, if you're interested in
probably because the first people said no.
Well, and I'm like, you're not. I'm like, we're not the first person.
Exactly.
I'm like, why? I'm like, we're talking about big national developers that are coming to us. And I'm like, if you're coming to CRED Capital, not because we're not like a legitimate firm, that they're coming to us because that we can raise the money and that we have a track record and we raised $50 million last year, and so they're like, you think CRED Capital could raise us the money?
Yeah, I just don't think we're the first on the list.
No, but it shows it's like, maybe none of this stuff is getting built.
Yeah.
Because they're coming to us.
That's a really good point.
All these projects that are entitled, I'm like, but who's funding it? Where's the money coming from?
Yeah. So, that's very interesting. Even from the very beginning of these projects, that could extend the tail a little bit of this. Right now, it's kind of perceived, but I think it's fairly set in stone of the construction.
It's perceived, but we see the starts. It's they're down. Unless they're going to speed up the construction timeline, you can build faster, and it's all announced next week.
And
it's not going to happen.
Me and John Chapman are he's our intern, but do we have a title for him that is beyond intern?
What do you think?
I don't know. I think he could be like research analyst, some kind of math genius intern. I'll find something polished. I'll find something a little more polished than that.
Right now, he is our summer intern, but he does have a specialty in statistical analysis. Yeah. We're working on. You guys are working on some really cool research.
Yeah. We just finding the ways that, and what reminded me of this is we're finding that there could be these high supply markets. They pop up back to positive very quickly.
Yeah.
A lot more quickly than we thought. We thought, oh man, they're down now. They're going to be down and out forever. But never say never. And the recovery could be quicker than anticipated. And so much to the effect where we ourselves are second guessing, like, is there a threshold where supply gets so high where job growth no longer drives rents higher, as a factor. So that's kind of what we're dealing with. But if the math works throughout, if it's a kind of linear thing, then there could be rent growth, positive rent growth in Austin and other similar places quicker than one might think.
Which is interesting because when that data started trickling out and we started talking about it, it was like, this can't be right. Like Austin seeing positive rent growth, kind of Q2 of 26 next year, and even John, who's doing the stats work, was like, he's like, I think that's just too aggressive. And part of the challenge is COVID just throws out these huge range of numbers that it's hard for like the algorithms to really kind of make sense of it all. But two factors. One, like, there is a lot of growth. There is a lot of absorption. There's been positive absorption. I'm talking about Austin now for the last couple of quarters. That's outpacing the new supply.
Yeah.
They still have negative rent growth. But also, we're talking about, base effects of they've had negative rent growth now for going on 3 years. So like negative, 12, 15% rent growth over the last, 2.5 years or so, plus or minus. So to say that they're going to have 2% rent growth, nominally, that's really not that much. That's like basically saying like, rents were $2,500 and they've come down to let's say $2,000, and now they're going to come up to $2,025.
Yeah.
It's like, okay, well, you know what? That's still a lot cheaper than it was a couple of years ago.
Yeah.
And the market probably can bear that, given incomes and wages in Austin. And that growth is so strong that I think that we are going to be surprised that there'll be a little bit of a snapback, because we've gone from an extreme high supply to then we're going to be in a extreme low supply, tight market, and it's going to happen much faster than investors will be able to react.
Yeah.
So you have to buy kind of now. Going on Matt's idea that prices are going to be higher, and ignoring the fear of potential, not ignoring, but almost looking through distress.
Put it in your factor, but that's not going to be the moment you're dealing with. Yeah. Super, super interesting. I don't know if you want to cover these just a couple of snapshots, and we can dig into them specifically a little later. I did want to mention, just like CRE prices are